Close your eyes for a second. Imagine it's 1750. You're in Japan, and there is one man who is so good at reading markets that people call him the god of markets. His name was Munehisa Homma, and what he discovered over 300 years ago is still the most used tool on every trading screen on Earth today. This is the real story of the candlestick chart. We are in Osaka, Japan. The year is around 1750. Rice is not just food. Rice is money. Samurai warriors are paid in rice. Wars are fought over rice. Entire cities depend on the rice price, every single day. And in this world, Munehisa Homma is the biggest rice trader alive. He will go on to make the equivalent of $10 billion. Not because he had better rice, but because he figured out something everyone else missed. Here is what Homma understood, that nobody else did. The market is not about rice. Say that again with me. The market is not about rice. It is about the minds of the people trading rice. Fear, greed, panic, euphoria. These emotions, they move the price, not the actual supply and demand, but how people feel about supply and demand. And here is the key. Human emotions repeat themselves, the same fear pattern, the same greed pattern, over and over again, across centuries. So if you can read those emotions in real time, you can predict what the crowd will do next. Before Homma, traders only tracked one thing: the final price at the end of the day. That's like a doctor who only checks if a patient is alive or dead, with zero information about what happened in between. You'd know the final score of the football match, but you'd have no idea who was dominating, when the momentum shifted, or whether the winning team was exhausted by the end. Homma needed more, much more. He needed to see the entire battle, not just the final result. So he invented a system. For every single time period, whether 1 hour or 1 day, he would record 4 things. Number 1, the open. Where did the price start? Number 2, the close. Where did the price end? Number 3, the high. What was the highest point reached? Number 4, the low. What was the lowest point touched? And he displayed these 4 numbers as one single visual shape. A shape that looked like a candle. The thick body shows the battle between open and close. The thin wicks above and below show how far each side pushed before getting rejected. In one tiny shape, you now had the full story of the battle. A big green body means buyers completely dominated. They pushed the price up and held it there. Buyers win. A big red body means sellers completely dominated. They pushed the price down and held it there. Sellers win. A tiny body, almost no body at all, means neither side won. Pure indecision. A standoff. This is called a doji, and it is one of the most powerful signals in trading. Now look at the wicks. A long top wick means buyers pushed the price way up. But then sellers came in hard and smashed it back down. The buyers tried. They failed. That's a warning sign. A long bottom wick means sellers pushed the price way down. But buyers came in strong and rescued it. The sellers tried. They failed. That could be a buying opportunity. Now here is the part that most people never talk about. The true genius of Homma's system was not the candle shape itself. It was what he did with time. He took the chaos of thousands of random transactions and sliced them into equal time boxes. Each box, one candle. Each candle, one complete story. Now you could line up those stories side by side, and suddenly, you could see things no one had ever seen before. Is the buyer side getting stronger or weaker over time? Is momentum building or dying? Is one side running out of energy? Time turned random noise into a structured, readable story. Homma kept this system largely to himself and his circle. For almost 200 years, candlestick analysis was a Japanese secret. Western traders were still using basic line charts. They could only see the closing price. They were flying blind. Then in 1991, a man named Steve Nissen changed everything. He wrote a book called Japanese Candlestick Charting Techniques, and he introduced this 300-year-old system to Western financial markets. Wall Street was stunned. Traders who had been using bar charts and line charts their entire careers immediately saw how much more information candlesticks carried. Within years, every major trading platform on Earth switched. Stocks, forex, crypto, commodities. All of them, now using the system a Japanese rice trader invented in the 1700s. So the next time you open a trading chart, and you see those candles lined up across your screen, remember what you are actually looking at. Not a price chart, a human behavior chart. Millions of people, buying, selling, panicking, getting greedy, all compressed into tiny candle shapes. Each one telling you exactly how the crowd is feeling right now. Munehisa Homma didn't just invent a charting tool. He invented a way to read the crowd's mind. And 300 years later, the crowd's mind still works the same way. That's why we use candlestick charts.